At this very moment, as you watch this video, a sum is being silently drained from your future. It's not a tax, it's not inflation. It's something most people never notice until it's too late. And by the time they find out, hundreds of thousands have already evaporated from their retirement account. No warning, no permission, no way back. And the worst part? You're probably paying it right now. Let me show you a number that will keep you up at night. An ordinary person who invests for retirement over 30 years can lose more than 1/3 of their total wealth just in fees. 1/3. That's not an exaggeration. That's mathematics. And in a moment, I will show you exactly how that calculation works, because once you see the numbers, it becomes impossible to ignore. But first, I need to tell you what happened to a couple in Australia. They worked their entire lives, decades of saving, doing everything right just like they were told. They contributed every month to their retirement fund. When they finally turned 65, they sat down with an independent advisor to review everything. And then the shock came. Nearly $200,000 had vanished, not from bad investments, not from a financial crisis, from fees. Fees that were right there, buried in the contract, eating away at their wealth year after year, like termites inside a wall, silent, invisible, devastating. And you might be thinking, but I check my investments. I know what I'm paying. Do you really? Because this is precisely where things get dangerous. There are at least 5 types of fees that most people never identify, and the third is the most treacherous of all. Remember that, because when I get to it, you will understand why it is practically impossible to detect. Let's start with the first, the management fee. This is the most well-known one. It's the percentage a fund or manager charges to look after your money. It seems small, 0.5%, 1%, sometimes 1.5%. Seems harmless, right? Wrong. Imagine you invest the equivalent of $100,000 in local currency. With an average return of 7% per year, over 30 years with no fees, you would end up with around $760,000. Now, with a management fee of just 1%, that figure drops to just over $570,000. You lost nearly $200,000 from 1%, a number that seems ridiculously small, but that over decades acts like a financial parasite. And the trick is that nobody shows you this number. You never receive a statement saying, "Congratulations, this year we took $15,000 from your future." The money simply doesn't appear. It is removed before you even see the return. Now, the second fee, the performance fee. This one is even more subtle. Some funds charge a percentage on any profit that exceeds a certain benchmark. So if the fund outperforms its target, they keep a slice of that excess. Seems fair? Maybe, until you realize that in the years the fund loses money, that fee is not refunded. You pay when they win. When they lose, the loss is yours alone. Getting uncomfortable? Good, because now comes the third one, and this is the one I said you need to pay very close attention to. It's the transaction fee. Every time your fund manager buys or sells an asset within the portfolio, there is a cost: brokerage, spread, market impact. These costs are deducted directly from the fund's assets. But unlike the management fee, they almost never appear clearly in reports. You won't see a line saying transaction fee. It is embedded in the buy and sell prices of the assets. It's a ghost. And the more the manager churns the portfolio, buying and selling frantically, the more you pay. In some aggressive funds, this hidden cost can be greater than the management fee itself. Read that again. Greater than the fee you already thought was high. And there's more. There's the fourth fee, which many people mistake for a service charge. It's the load fee. In many private pension and retirement fund products, there is a charge at the moment you invest your money or at the moment you withdraw it, sometimes both. So before your money even begins working for you, a portion is already gone. It's as if you entered a race starting 10 meters behind everyone else, and at the finish line, you lose another 5 meters. But the fifth fee, that is the cruelest of all, and it's probably the one that will surprise you the most. It's the invisible opportunity cost.
It's not a fee charged by anyone. It's the cost of what you failed to earn by being in the wrong product. When your money is sitting in an expensive, underperforming fund, while cheap alternatives that track the market are available, every year that passes is a year you are paying more to earn less. And that gap compounds exponentially over time. Let me give you a concrete example. Two investors, same amount, same time horizon, 30 years. One invested in a fund with a total fee of 2% per year. The other invested in an index fund with a fee of 0.2%. At the end of 30 years, the difference between the two is staggering. The investor in the cheaper fund ended up with nearly double the wealth. Double, not 10% more, not 20, double. And do you know what's most disturbing? Both thought they were doing the right thing. Both were investing for the future. The only difference was how much each one paid to invest. Now, why does nobody talk about this openly? Simple, because these fees feed an entire industry. Managers, distributors, platforms, advisors who earn commissions. There is a billion-dollar ecosystem that depends on you not paying attention. And they are very good at keeping everything comfortably confusing. Have you ever noticed how fund documents are written? Fine print, technical language, tables that seem to require an accounting degree to understand. That is not an accident. The harder it is for you to understand what you're paying, the easier it is for them to keep charging. But here's the part that changes everything. You don't have to accept this. The first thing you can do is find out exactly how much you are paying today. Take each investment you have earmarked for retirement. Look for the document called the Fund Fact Sheet or Information Sheet. Find the management fee, the performance fee, and ask directly about transaction and load costs. If your manager or bank cannot give you those numbers clearly and directly, that is already a massive red flag. The second thing, compare. There are index funds and ETFs with absurdly low fees that historically outperform the majority of active funds over decades. This is not opinion, it's statistics. Study after study shows that the vast majority of active managers cannot consistently beat the market once fees are deducted. So why pay 5-10 times more for a worse result? The third thing, and perhaps the most important, calculate the future impact. Use any compound interest calculator freely available online. Enter the amount you invest, the time until retirement, and compare two scenarios, one with the fee you pay today, another with a lower fee. When you see the difference in absolute numbers, in real money that would be sitting in your account, the decision becomes obvious. Remember the couple I mentioned at the beginning? After they discovered the damage, they moved their entire portfolio to a low-cost index fund. In the following 5 years, the savings from fees alone represented the equivalent of 2 years of retirement expenses. 2 years of life, financed simply by stopping the payment of unnecessary fees. And that is what deeply troubles me. It's not that people are irresponsible. They do the right thing. They save, they invest, they make sacrifices. And yet, a significant portion of those sacrifices is silently redirected into the hands of those who, in many cases, deliver no proportional value in return. Every day you go without checking this is a day in which the power of compound interest works against you instead of for you. You have spent decades building your future. Don't let invisible fees destroy what is rightfully yours. Now you know where to look. Now you know what to ask. The difference between those who lose a third of their retirement and those who protect every cent is simply the information you just received. Use it today.